Alright, hello everyone, welcome back to the channel. This is Emil, and in today's video I want to talk about share buybacks. So first we'll talk about what a share buyback is. We'll run through the more obvious reasons why companies do share buybacks, and then I'll run through some towards the end, some of the reasons you might not know why companies do share buybacks, or kind of less obvious reasons to why a company would buy back its own shares. So what is a share buyback? It's exactly what it sounds like on the tin. It's essentially when a company takes money that it's earned and buys back its own outstanding public shares. So this reduces the outstanding number of shares on the market and increases the ownership of the company by the company. So let's quickly run through the obvious reasons why a company would want to buy back its own shares. So what most people think, and which may be true in a lot of companies, the reason that a company would buy back its own shares is because the executives of the company get paid depending on the stock price and how well the stock is doing, or stock-based compensation. So that's one of the more obvious reasons why company executives are really focused on making the shares more valuable, the outstanding shareholder shares. So if they're buying the shares, that will increase the price of the outstanding shares and make the outstanding shares scarcer, less available, so any new buyers would have to pay more. So they're essentially artificially adding new buyers into the market, which drives up the price of the shares. Another more obvious reason why companies like to buy back the shares is to make the numbers look better, particularly the EPS, so the earnings per share. So if there's less outstanding shares on the market, even if a company earns the same amount of money year in, year out, but the company has been buying back its own shares, this is going to make the earnings per share increase in line with the buybacks. So the earnings per share will increase just because of the buybacks. So it's just another way to kind of fudge the numbers and make them look better than they potentially are. So those two reasons kind of seem like buybacks are kind of a bad thing, and buybacks have certainly gotten a lot of bad press recently. I'll talk about that in a minute. Another reason a company might do buybacks is if they genuinely believe their company is undervalued. If their stock price is taking a big hit, they might be like, oh, we know this company is going to do a lot better and the earnings are going to increase over the future. There's some short-term trouble, so we'll buy back our shares because they're ridiculously cheap at the moment. So that's a legitimate reason why a company would buy back its shares. Okay, so one company that has really been in the spotlight for doing bad share buybacks and given buybacks a bad name is Boeing. So as you may know, the Boeing 737 MAX, one of their airplanes, their newer ones, there was problems with it, so a lot of them had to be grounded and there were a lot of cancellations. A lot of the 737s were cancelled by airlines, so Boeing's earnings took a really big hit, and their stock price, which had been steadily increasing well for a number of years because of buybacks and because of confidence in the stock, basically should have dropped because they weren't selling any planes, but Boeing just kept continuing to do buybacks and buybacks and buybacks, and now the coronavirus situation has come, and obviously no one's buying an airplane at the moment, so the Boeing stock has absolutely crashed, and now they have no money at all on their balance sheet. They have no cash to weather them through the storm, so they're getting bailed out by the government. Yeah, so Boeing had been buying back loads of its shares and now has no cash on the balance sheet when they really need it. So they're in a really bad light in the press and the media because they've just gotten a bailout from the government, from taxpayer money, because the executives have been silly, just buying back its own shares for the sake of it, just to increase the executives' pays, the executives' wages and salaries or whatever. You want to be doing buybacks when your stock price has dropped. You don't want to be doing buybacks all the time when your stock price is at an all-time high. You don't want to be doing massive buybacks, maybe just a little bit. You certainly, if you're a buyback company, you definitely want to be have money to buy back shares if the stock price tumbles, so your shareholders don't get absolutely hammered. But obviously Boeing couldn't do this. Okay, so now let's talk about the less obvious reasons why a company might buy back its own stock. Okay, so one reason a company might buy back its own stock is if it's a dividend paying company. So for example, Visa or Boeing or both dividend paying companies. So say they have a million shares outstanding, and each of those shares gets $1. I know it's not gonna, it's much different to that, much more. But so say there's a million shares owned publicly by retail investors like myself or institutional investors. So there's a million shares and they all get $1. If Boeing goes and buys back its own stock, say it buys 100,000 shares over the course of a year, now it's just reduced its dividend obligation by 10% forever. So essentially now there's only 900,000 shares that are owned publicly or by institutions. Boeing doesn't have to pay itself a dividend. So it's much if a company buys back its own shares, it's much easier to continue paying the dividend. So there's less people to be paid, and a company can actually much more easily increase the dividend, which every company wants to do. It wants to be shown that it increases its dividend every year. So it's much easier to increase the dividend if there's less people who are waiting for a dividend, if there's less shares outstanding that require a dividend. So in recent years, buybacks have become more popular than dividends. In the olden days, the only way really that a company could reward its shareholders was by paying out dividends or by reinvesting in the business to make the share price larger. But now this is a new way to reward shareholders, and it's actually become more popular. Companies are putting more money into buybacks than they are in dividends anymore. No, dividends have to be paid with after-tax dollars. So after a company's got all its earnings, it has to pay the tax and then it can pay the dividends. So it's a hard obligation. Because interest rates have been so incredibly low over the last number of years, companies have just been taking out debt to buy back its own stock. So essentially they're getting debt at 1 to 2% or maybe up to 5%, and then they think by buying back the stock that will create a return of more than 5% for the shareholders or 2% for the shareholders. And on top of this, the interest payments on the debt is actually tax deductible. So they're taking out debt, so they're basically getting free money to buy back the stock, which increases the shareholder wealth and increases the pay salaries for the executives and everything like that, and takes shares off the market, which makes the owner shares more valuable and more scarce. However, companies can definitely go overboard with this. They take out loads and loads of debt that still has to be paid off, even if the interest is tax deductible. It still has to be paid off, so you definitely don't want a huge amount of debt on the balance sheet just to buy back your own stock and then it kind of artificially inflate the stock price. Alright, so this is the final reasons why a company might like to do buybacks that you might not think of. And then I'll just go through my opinion on buybacks and whether I like when a company that I own does buybacks. Okay, so it's kind of another thing that looks good rather than something that's actually fundamentally good for the business. But saying in a time of recession, every company obviously is going to, most companies are going to earn less money. And say a company pays both dividends and does share buybacks for its for its shareholders. A lot of shareholders, particularly retail investors, don't really pay as much attention to the buybacks as to the dividends. The dividend is a lot more obvious to see. As you can see the dividend yield, you can see the dividend being paid out into your account, but you can't really see the buyback. Retail investors often look at the dividend history of a company, and if they see, they've consistently grown their dividends, even through times of recession, they've grown their dividends and they haven't cut their dividends in 10 or 15 years. That looks great to a retail investor like myself. However, we might not realize that, say a company spends 50% of its spare money on dividends and another 50% on buybacks. In times of recession, they'll completely cut the buybacks and keep the dividend going, so they can keep the dividend increasing even through times of recession to make things look better. So what are my thoughts on stock buybacks? Personally, I think they're great. I think they're great for if you own a company and a company is consistently buying back its own stock within reason. You can be sure, like, the management unless it's a really poorly managed company, a company won't really buy back its stock if it's way elevated prices. So they obviously the executives obviously have some confidence in their company if they're buying back their own shares and they're committed to reward the shareholders in that sense. And I also believe that it's more tax friendly. So if a company's paying a lot of dividends, they have to pay that after tax. And if a company pays a lot of tax, that doesn't help the investors at all. It doesn't help the shareholders, the owners at all. Paying more tax doesn't help. So buybacks are good in that sense as well. Just to summarise, I think buybacks are great unless a company is just being totally reckless with buybacks and buying back tons of stock when it's at all-time highs and the outlook might not be so good and they don't have a fantastic balance sheet. You mostly want to see a company with a great balance sheet but buying back its own stock, because then when times are tough, they'll still be able to weather the storm. They're safe. They're a safe company. You don't want a company with a crappy balance sheet to be buying back loads of its stock. That's very worrying. Okay, I hope you enjoyed the video and you learned something. If you did, please drop me a thumbs up. Comment if you have any potential video ideas for the future. I'll most likely do it. Subscribe for more content like this. I have loads of really interesting videos coming up. Thanks so much for watching. I really appreciate it. I'll catch you all in the next one. Cheers.